Hi, everyone. Thank you very much for joining this short webinar we're doing for vets and anyone who's associated with the veterinary industry. I'm going to get this started in the next 30 seconds or so, and I'm joined this evening by my colleague, Cliona O'Donoghue, who's going to be helping me this evening just in terms of dealing with some of the questions that we've had over the last couple of weeks. And I would like to thank you for your participation. Just before we kick off, I'm just going to run a poll just really to get a sense of what's important to people. We have had some questions in different areas, such as mortgages and helping people in terms of reducing the tax that they pay. And I would encourage you all as well, if you can, maybe ask any questions on the Q&A function. We really would like to try and make this as informative as possible. So for those of you that don't know me, my name is Nick Shaw-Lambus. I am a financial advisor in Alpha Wealth. Cliona O'Donoghue's head of business development. And as I said, I'm just going to spend the next kind of 5 to 10 minutes going through one or two areas in terms of getting you to help your money work harder for you. And then we're going to go into kind of a Q&A session. And I'd like to think that there will definitely be something that you can take away from the session this evening. For those of you that just joined, please do feel free to answer the poll question. We're just trying to make this as, I suppose, informative and obviously for future sessions. And for anyone who is interested in maybe getting a little bit more information, please do go onto our website, Alpha Wealth. There's a lot of useful tools and videos, a financial budgeter as well, which I think you'll find very useful. So just before I kind of start, just to tell you a little bit about us, there's 8 qualified professionals. We're based in Cork. We do have a small presence in Dublin, and we work with individuals really in terms of trying to give you some guidance around planning for your financial future. And it tends to get segregated into 3 areas, which is typically around getting your money working harder for you, which is going to be the mainstay of this evening, talking about tax reduction schemes and planning for your retirement. And then lastly, in the area of mortgages, insurances, and helping people save money with a lot of the, I suppose, expenses that we go through. So I'm just going to start in the first area of tax planning and tax reduction schemes. I'm not going to focus too much on this, but pension schemes, in my opinion, are a really effective vehicle, and I do believe that they're underutilized. And I think from the slide here, you can see that for anyone who's in a position where they can invest money in a pension or indeed make a further contribution to a pension, the example that you can see on the screen here is that if you invest €1,000, revenue, if you're earning over 36,800 a year, will give you 40% relief pretty much immediately. Now, if you put that in context and maybe turn it around, if you invest €600, you get €1,000 of a contribution into a pension scheme, which is a 66% return on your investment. And that's really why pensions are very powerful. The fact that they grow tax-free and the fact that you can get access to 25% of the fund when you draw the fund down tax-free also makes them, in my opinion, very valuable. This is another example of a tax reduction scheme. Not a lot of people are that familiar with it, but it's a government-backed scheme called the Employment Investment Incentive Scheme, or more commonly, the EIIS scheme. Now, I'm not going to go into too much detail this evening, but just to give you a very quick example of how this operates. Let's say, for example, you're earning €50,000 a year or more. You are therefore undoubtedly earning at least €10,000 of that at the higher rate of tax. In order to qualify for this scheme, you have to have money that you're prepared to invest over 4 years. And by virtue of doing so, you will get 40% of your investment, which is €4,000 in this example, back from the government early in the following year. You also look to get your money back and a return on your investment from an Irish company of your choosing that qualifies under this regime. And there's roughly about 60 to 70 companies a year that look for this type of finance. And I'd like to think as independent brokers, we are helping our clients find the best companies and narrowing down the options. A couple of examples of companies looking to raise finance this year are an IT company in Dublin called MX, a really strong growing company. There's a whiskey company in Cork called Kinsale Spirit, and there's a renewable energy company also in Dublin called BVP who run a fund. But again, it's just about giving you a very high level example of how you can reduce the tax that you pay. I'm going to touch upon getting your money working harder. And obviously, we're all aware at the moment that we're suffering from an issue of very, very low interest rates in the banks, typically negligible. That applies to the bank, post office, credit union. And also we have the advent of increase in inflation, which is causing a problem, obviously, that the value of our savings is reducing roughly by about 5% a year. So what we're helping our clients with is looking at alternatives. And the scale that you can see on the screen here, this chart is really powerful. And whenever I'm talking to people around saving for your retirement or saving for your kids' education, or indeed for a property, I always suggest that they get a sense of exactly where their money is and how hard it's working for them. And the key thing about this is that the longer that you save for, the more risk you should accept. So for anyone who's in their 40s, for example, who's looking to put money away into a pension scheme, should really be prepared to accept risk in the region of risk level 5 on that scale of 1 to 7. However, if you have a much shorter time scale, let's say 3 years, you really want to be on the lower end of that scale because you cannot afford the time that it could take to recover from any pullback that you may experience. Now, again, we'll touch upon it later, but you probably are aware that at the moment, stock markets have performed quite poorly, particularly in April. On average, they're down about 5 or 6% this year, and some people are a little bit fearful of that. But we must take that in context of the returns that we've seen over the last 2 years, which have typically been double digit. And it's looking at these, I suppose, asset classes over a longer time. So this is a really interesting graphic about helping people save money. And the figure of 30,000 is used because it tends to be kind of an amount that people need to accumulate either for a deposit for a property, or indeed, let's say if you're looking to save for a new car and buy it outright. And the thing to take away from this graphic is that, firstly, the more time you give something, the less you have to put into it. So obviously for anyone who's looking to say, generate 30,000 euros over the next 7 odd years, can save around 300 a month. However, if you're looking to say, accumulate 30,000 over 5 years, you typically need to be putting closer to 500 euros a month. Now, these returns are based on getting a return of your savings of about 3.5% per annum. That is blatantly not possible in the banks. And this is why we're looking to some alternatives. And one of the best companies that we like dealing with as an independent broker is Zurich. We find that they have very, very attractive products, really good investment management, and it's about making sure that you have the right product at the lowest fee. This particular savings plan, and you can see some information here on the screen, we recommend it for 5 years plus. It's hugely flexible. You can put in whatever amount you feel comfortable with from a minimum of 100 euros a month. And we work with our clients to help them understand the benefits of these and make sure they get them at the lowest fees. Some clients we talk to have the right type of plans, they just pay too much. And I'd ask all of you to consider, if you are looking at these types of schemes, make sure that you get the lowest fee possible. And as a low-cost broker, we'd like to suggest that we'd be in a very good position to offer you that. This graphic shows a really good example of maybe, parents who are saving the child allowance in, the longer term. And you can see here over 12 and 18 years, you can accumulate a fund of about 25 to 42,000 based on making contributions, but again, at that 3% rate. So it's useful in terms of trying to help people plan. And this is what we do as part of the planning process. Finally, I'm just going to talk very briefly about mortgages. I'm going to get onto the Q&A, but this is an example of clients that I was talking to actually about 2 weeks ago and how we can help people save money. They were paying a mortgage interest rate of 2.95% over 30 years, costing 1,256 euros a month. I asked them to contact their bank, which was AIB in this case, and they were able to reduce the cost of their mortgage by breaking their fixed rate. They had another year to run at a cost of 200 euros to get onto an interest rate of 2.2%. And that reduced the cost of monthly payment down to 1,139 euros, saving them about 40,000 euros interest over the remaining term of their mortgage. It's a significant return, and it was just for the sake of one phone call. And there's lots of opportunities out there for people to look at their mortgages, regardless of whether they're fixed or not, and just to see what maneuverability they have. And all I ask them to do is find out what the cost of breaking their mortgage is. We're obviously aware of the fact that some of the banks are leaving Ireland, KBC, Ulster Bank, and there is a massive opportunity before rates increase. We saw last week that Avant increased their mortgage rates for the first time. ICS did so about 2 months ago, and are looking potentially at a second increase. Rates are definitely going to rise. So if anyone is in a position to, they should try and fix now for a relatively long period. So we're going to get on to the Q&A part of the discussion now. We're going to finish within the next 20 minutes. So please do ask any questions if you'd like to. But just to summarize, we give advice on things like savings accounts for kids, retirement planning, tax back accounts, and obviously my contact details are there on the screen if anyone would like to make contact with us. We are not charging anyone connected through this webinar for a financial consultation. We normally charge 199 euros plus VAT, and it's, as I said, complimentary for anyone who's listening to this either live or indeed on playback. So I'd like to now invite Cliona, who's going to run through some of the questions that we've received over the last number of days.
Thanks, Nick. So the first question that came in today is around pensions. So it just says, I would like it if you could address pension protection, given that a lot of people lost money in pensions when the crash happened in 2008. I myself have no pension in place, as I am always hesitant due to the possible risks involved, especially given the current economic situation with inflation, rising government debt, etc. So this obviously may lead to another crash, is what the concern is here. So can you give your views on that, Nick?
Absolutely. So what happened back in 2008, 2009 was extremely unfortunate. I was 35, 36 years of age when it happened. And the key thing to understand is that for those people that did lose money, myself included, in investments like pensions and investments, the point being is that if you had time to recover, which I did, within 8 years, what was lost was made back, and then it has increased significantly since. Now, as I mentioned earlier, there was a pullback over the last 6 to 8 weeks, not primarily because of what's happening in the Ukraine, as terrible as it is. It was mainly on the back of rising inflation and interest rates and a fear of a little bit of uncertainty globally. But it shouldn't stop people taking advantage of these tax efficient investment vehicles. If anything, it is more important, because getting the tax relief alone is the first part of the savings that you're going to try and achieve. And therefore, it makes more sense in my view. But the key thing is to understand the level of risk you're involved with. You do not have to take large risk with your pension. But again, if you have a long time scale, you can recover from these pullbacks. And by virtue of saving monthly into these schemes, you are reducing the risk by buying into them on a rolling basis, 12 times a year, obviously, as opposed to once.
The next question is around pensions again. If I am on the lower rate of tax, should I be investing in a pension?
Yes, but it's not as advantageous. So for anyone who's earning less than the threshold of the 36,800, you're going to get relief on your pension of 20%, as opposed to anyone who's earning over that. So what I would say to people in that instance is it's about balance. Make sure that you're, I suppose, not paying interest on debt at a relatively high rate in lieu of maybe putting money into pensions and only getting relief at 20%. But typically, I would suggest that when you should really go at pensions is when you are in the higher tax bracket.
I bank with KBC. Should I do anything now?
Yeah, KBC obviously leaving the Irish marketplace, you'll be forced to join another bank. Now, there's been lots of issues about people who are trying to switch banks. People often ask me, Nick, which is the best bank to go with? When it comes to mortgages, there are very, I suppose, appropriate banks for certain people, depending on, your loan to value ratio or whether you're a first time buyer or not, and indeed whether you're building. But in terms of banking, I would suggest that it's really a case of finding a bank that works for you, whether it's an online bank or indeed if it's a local branch that you can walk into. But it's a case of I would get that done, because KBC is certainly not making it very easy for people.
The other one is, I have 2 young children and I'm interested in saving for their education. Is there a particular account, or what would you recommend is the best vehicle to save?
I alluded to it earlier, but the Zurich savings account is really ideally suited for people who have children. I have 4 children myself, and I've always put money into savings because the banks are not going to serve you. And I keep saying this, but anyone who's saving into, short-term institutions, which is really anything less than 4 years, i.e. through the bank, post office, it's pointless, because inflation will erode that money, and we're being forced to look at alternatives. And the best example I can give you is at the post office 10-year bond that was really, really attractive 8 years ago, paying interest of 50%, for the same account now pays 7.5%. So what a massive fall in rates that are being offered by these institutions. So we are being forced to look at alternatives, and the Zurich savings account is by far the best.
How much of a pension pot should I aim for, and what percentage of my salary should I invest in a pension?
It's a really good question. There is no hard and fast answer. I say to people, if it's possible, you should try and aim for 800,000 euros in your pension pot. And I know it may seem like a random figure, and you might say, Nick, why 800,000? If someone can achieve that, it's the maximum that you can get from your pension tax-free, which is a quarter of that, which is 200,000 euros. And the balance of that, which is 600,000, you can draw a rate of that of, say, 5 to 6%, and that'll give you an income of around 35 to 40,000 a year, which is an appropriate level to keep you on the lower rate of tax. And by virtue of the interest that you should earn from your pension, this 600,000 that's left, you'll ideally leave your pension fund untouched, the 600,000, which will pass as an asset to your partner, and indeed to your next of kin, and ideally your dependents. And that's why that, if it's at all possible, is the figure that you should aim for. Now, obviously, many people are in different scenarios, maybe starting late, may not have the ability to put money into pensions as much as they'd like. But the general rule of thumb is 10% of your salary should go into a pension. So for anyone who's on 50,000 a year, yes, I'd be saying to them that they should be putting 5,000 a year in. The good news is, however, you get 40% relief on that. It only costs you 3,000 a year, which is 250 euros a month. And by proper planning, and this is where we help people, I do think that that should be achievable.
Okay. Should I be investing my pension in a high or low risk fund?
We've touched on that earlier, but it depends on your age and the time of which you look to draw this pension down. People look at pensions as being accessible from 65. That is not the case. You can access your pension from 50 years of age onwards. It's generally not a good idea to do so, however, until your income falls. But I have many clients who are looking to, say, draw their pension down at 60 whilst continuing to work, but they want to work, say, reduced hours, or maybe change their occupation type. I was talking to someone earlier who works for a pharma company that's likely to be made redundant. And I said to them that through proper planning, they should look to access their pension at 60 and use the severance package for the intervening years. And we mapped out over the next 30 years how that would work for them. And it was really powerful to see it, obviously on an Excel sheet that we would provide for them.
So this is from a vet that says, I have employees in my practice. Should I pay into a pension out in protection for them? What is the benefit of doing this?
So as a business owner myself, we have 8 employees in Alpha Wealth, and we've set up provisions for pensions for staff, which will become mandatory in the next 3 years, as many of you may have heard, through something called auto enrollment. But on top of that, the main reason why we've affected provisions for staff is because it engenders good relations, obviously, with employees. It provides, I suppose, a little bit more in terms of the engagement that we have with them and loyalty, but it's also more effective and tax efficient for the company. So, for example, I have employees where they get bonuses, and instead of maybe paying into their salaries as a bonus, where they lose 52% of it if they're a high rate taxpayer, and it costs me employees PSI, the full contribution of, say, let's say €1,000 can go straight into the pension scheme. I pay no employees PSI, and the employee doesn't lose 52% and has that money then growing tax-free for them in the pension environment. So it's kind of a win-win. There is a provision for things like group risk where you can protect 3 or more employees on a very, very low cost basis. It's very morbid, but in the event of if any of them pass, you can insure up to 4 times their salary. There's no medical underwriting, there's no application forms. And it's a really great way of, again, just protecting the business and also not having really what would be tragic conversations with, next of kins, and being able to make sure that there are some financial provisions in the event, and hopefully in the unlikely event that something does happen.
Back to mortgages for this question again. I am looking at getting a mortgage in the next 2 years. Which is the best bank to go to?
There's no, again, hard and fast answer, but Avant and ICS were offering the lowest rates on the market up until recently. There was rates around 1.95%. Now, some people who are looking to buy new properties, typically they should be getting on green mortgages, which most of the institutions are now offering in and around the 2% level. So I'm not really that fixated about which bank. I'm more interested in what the rate of interest is. And the one key question I always ask people when I talk to them about mortgages is, what is the rate of interest you're paying and for how long are you paying it for? So there's no point being on a good rate that's going to expire in the next year or two. Because what's going to happen is you're going to find that by the end of the fixed term, you're going to come out of this fixed rate in an interest rate environment that's going to look very different to what it does today. And then you're going to get caught with higher interest rates. So this is the point I was making earlier about fixed now at a low rate for a long period. And it's very easy to do. You may not have to move. And in many cases, you don't have to. But even if you do, the hassle of moving a mortgage is no more near any bit hassle than it was when you first got the mortgage. The fact that you're living in the house and have proven that you can repay the mortgage, banks are much more willing to talk to you.
So the next one is, I have a capital sum. Is it best to pay off my mortgage or invest in my pension?
This comes back to what we were saying earlier about balance. And typically, as a financial advisor, in my opinion, if you're a higher rate taxpayer, it is more sensible financially for you to put money into a pension scheme for the reasons I've mentioned earlier. However, it would depend on certain circumstances, such as I was talking to a client earlier in the week who knew what I was saying was correct, but they just felt that they wanted to pay back their mortgage. They just had it, it was just I suppose, in their psyche, and that's fine. It does depend. And then we had a discussion around balance. So they had a lump sum, and rather than paying all of the balance off the mortgage, we agreed that there was a split between paying some off the mortgage and putting some towards a pension, which basically ticked both boxes. They got the tax efficiencies, but they also felt more comfortable with the fact that they owed the bank less.
Okay, we've a question that's come in there. It's, I have one dependent returning to full-time work next month. I have minimal financial planning in place. Is helping me make the best choices with my earnings something you can offer?
Absolutely. So I mentioned earlier about, there's some really good financial tools. If you go to our website, you look up our Instagram page, you'll see our financial budgeter. It's the one thing I say to people, it's the first thing you should do. I'd like to get a sense of, what your incomings are and your outgoings. And this is where working with a financial planner, and as I said earlier, we're not charging a consultation fee, and we provide a really good service. It's really easy for people. I don't need people to go and find policy documents in a drawer anywhere. All I ask them to do is try and provide me certain information, which we provide to you in terms of certain questions about your earnings, dependents, and so on. And then we help you better manage your money. A very quick example I'm going to give you is on health insurance. Many people are paying health insurance at the moment in Ireland. I have health insurance myself. As I mentioned, I have 4 children. I only ever pay health insurance for one of them. You can get discounts with some providers. And also, I have the same plan for 10 years with Leia. And every year I cancel it and rebuy the same plan with a 10% discount. But I have to do it myself. They won't give me the discount automatically. But by virtue of that, the health insurance plan that should cost me €970 a year only cost me 880. So I save myself €90 a year for about 2 minutes work.
Good tip. I am considering setting up my own practice. Do you have any advice on this?
Yeah, so again, having been through the process myself of setting up a company, I talk to people who are looking to potentially set up their own practice or go on their own. And I'd like to think that, again, as a financial planner, we can help them in terms of the understanding of the benefits, some of the implications of doing so. And we work very closely with several accountants in all different parts of the country with no, I suppose, obligation to take the advice that we give you. There's no bias. We don't get paid or charged for this, but it's about understanding, how it can work for you and what the advantages and disadvantages are of, setting up your own practice and what it might mean.
I have some cash on deposit in the bank and thinking of investing. What are the best options for me?
So we're back to this menu board of, how best to use your money. And as I say, when I'm sitting down with someone, it's talking to them about, like, do you have any loans that you're paying interest on that are quite high? For example, if you have a credit card, that's the first thing that you should look to pay off. In an instance of, say, monies that you have sitting in the bank, obviously it's not sensible to keep too much of it earning no interest. And again, we're back to the 4-year rule. Can you afford to put that money away for 4 years? And if so, there are these options. I've spoken about a few of them, pensions being one, the EAAS scheme if you're a higher tax rate payer, which is another opportunity, the Zurich savings plan I mentioned as well. And then it's finding, the right proportion for you, depending on what your goals are. So if you have children that are coming up to, third level education, and making sure that you're planning, carefully for them. But again, and I don't want to keep repeating myself, but check in with us for a free financial consultation. It's a 30 to 45-minute complimentary review. And I absolutely believe that we'll be able to help you with that in a very meaningful way.
We're coming close to the end of the questions here. So just if anybody else would like to pop something into the chat box, I'd encourage you to do it if you'd like anything addressed. The next question is just around income protection. So should I have serious illness or income protection, and what is the difference between them?
It's a really good question. So basically, very quickly, serious illness cover is a lump sum that you would receive in the event of suffering a specific condition that's mentioned in the terms of the policy. However, income protection, which is a policy that I favor, certainly for vets, particularly for those that are obviously dealing with, say, large animals and so on, is that if you are unable to work through illness, disability, injury, or accident, you will receive a percentage of your income capped up to 75% on an ongoing basis. And the difference with that is that you get tax relief on the cost of the policy. You don't with serious illness cover. Now, there's an argument that you should have both, and I would subscribe to that. Most of the claims for serious illness tend to be cancer related. Most of the claims for income protection tend to be more down to stress and also orthopedic issues. But again, it's about understanding the costs versus the benefits. And this is where we'd like to suggest, as a low-cost broker, we can give you options. We're not tied to any insurance company, and we can help you understand and see what's best for you. And sometimes it's a case of applying for these and finding out whether you can get cover, because there's no point saying, okay, I want income protection. You apply and find out that the insurance company have either increased the premium significantly, so it's not very cost effective for you, or indeed excluded certain conditions that you may have had or ailments. And again, equally, it doesn't make sense. So it's about a step-by-step process in understanding, the options to you. But yes, definitely income protection for any vets who are not covered, because obviously you are in a slightly higher risk occupation type. And it's really about an understanding of, making sure that you do have some proportion of your income covered to cover the eventuality of paying certain bills, including the mortgage.
So I'm not too sure if you've kind of addressed this, but it's the last question, and it's just around mortgages again. What should I do to reduce my mortgage costs?
It really comes back to the rate of interest you're paying. Anyone who's paying over 2.25%, I would urge you to contact us. We'll tell you about how you can navigate a lower rate. It may not be able to be done automatically. And again, it's about finding out the costs of breaking that. But we work with a number of mortgage brokers. And again, as an independent company that do not provide mortgages, so we are giving this service with no bias. it will save you significant amounts of money. And it's probably the best financial tip that I can give you is go check and see what rate of interest you're paying on your mortgage. And if it's over 2.25%, please do reach out to us, and we'll help you get the rate down.
So I don't see any other questions coming in. I think that's everything that we have for this evening in terms of questions. So I'll just hand it back to you, Nick, to
Thank you.
wrap
And
it
thank
up.
you very much, Kalina. So we did say we're going to finish dead on half an hour, guys. So we are there. I'd like to thank you for joining this, and for anyone who is listening on the feedback, please do feel free to give us any feedback in terms of things that you might like us to cover in the future. Myself and Kalina will be doing a Q&A again on Monday, the 30th of May. It'll be the last one before the summer break. So please do reach out to us to find out more about it. And we will email you on the video if anyone has missed any part of that or would like to listen again, or indeed share it with your partner. A lot of what I've spoken about this evening is not just for vets. It applies to most occupation types. And certainly it's about making sure that you are getting proper financial advice. And even if you're dealing with a broker yourself, go back to them. And if you want to use us just as an independent body, just to kind of verify something or however trivial, please do so. So that said, as I say, my email is on the screen there, indeed, my mobile. Please do feel free to make contact. And thank you very much again for your time. It's very much appreciated. I hope you enjoy the rest of the evening. Thank you.